All right. Hello, everyone, and welcome to our Founders Equity Talk with Osage University Partners. My name is Katie Hemphill, and I'm Director of Technology Ventures and Talent Network at Northeastern University's Center for Research Innovation. It's great to have all of you join us today. We will be recording this session so that you have the option to review it at a later date if you'd like to come back and hear more about what we talked about. I'm going to introduce our speaker, Manny Stockman. Manny joined Osage University Partners in 2015. At Osage, he has invested in core technologies across software, computing, and hardware. He has held a director or observer role at Everactive, NewMat, Sci-Fi, and IonQ. Prior to joining Osage, Manny was at Lockheed Martin and Skunkworks as an engineer executing on the transition of early stage technologies into the defense industry. He often joined university researchers with his industry team to develop unique technology solutions across the materials, applied physics, and photonics domains. Without further ado, I'm going to hand this virtual mic over to Manny. And as I do, I want everyone to be aware that Manny is very open to questions today. So please do feel free to bring yourself off mute, turn on your camera if you'd like, ask a question live, and or throw a question in the chat if you'd like Manny to try and address it as part of his presentation. There will be some time for Q&A at the end, but please feel free to be as interactive as you want to be. With that, Manny, handing over the virtual mic.
Awesome. Thanks, Katie. And thanks to Northeastern for hosting this event. It's actually Northeastern has the honor of being our most recent partner at OUP. And I'm glad that we have had this webinar set up like almost as the ink is drying on the relationship. And just so everyone kind of has the context of what that means, we invest in startups that spin out of university research. And we've been doing this since around 2009. We've invested in around 130 startups that have been founded by faculty and graduate students and entrepreneurs, all focused on commercializing technology out of the university ecosystem. And so it's been great to kind of increase our work with Northeastern and really formalize the relationship. And so this is hopefully the first webinar of many. As you all hear what we have to say, feel free to reach out to Myron and Katie to say, hey, it would be great to hear a conversation or a webinar on this. And we are always looking for new ideas, and so please inject them into our content engine. So with that, I'll pull up some slides for us to share. Let me know if you guys can't see them. And I really do, encourage just interrupt me at the end of a slide, ask a question. Feel free to put it over chat, whatever's easiest for you. And Katie will make sure to get my attention if for some reason I'm not noticing them over chat. But the best way to get my attention is just to join the conversation. So please do. So this topic that we're going to go over today is a discussion that we've had with many of the university researchers we work with and many of the tech transfer offices that we work with at those institutions. And it's on this really complex, thing to navigate, which is you're starting a company based on your research with a couple co-founders, and how do you split up the equity? What's the right way to do it? How do you deal with all the different incentives and conflicts that occur when your peers in the academic setting transitioning to a commercial setting, and not everyone necessarily is going to be going forward with the same level of effort? And so we created this presentation to discuss that. And please feel free, once again, to ask questions, even if they're kind of ill-formed. I love just sort of hearing what people think as I go. So with that, my background is I'm a partner at OUP. I've been here for around 7 years now. As Katie said, before that, I was at Lockheed Martin doing really early stage R&D, very hard tech stuff. And at OUP, I've tended to focus on that space as well. I like a lot of our computing companies and materials companies. But also we are very broad, and we'll look at software as well, in addition to our life science team. So please feel free to reach out to me with what you're working on, or if you just want to brainstorm about startups, I'm happy to chat. But that's all the plug you're going to get about myself and OUP today. It's really just about equity and dilution. So I'll jump right into it. So founders equity is meant to be something that you reward the team that is going forward with the company. But going forward means many different things. It could be 0% all the way through 180 to 200% of someone's time. And when you are splitting up equity, it is your way of both rewarding for past performance and incentivizing future performance. And so we like to break your decision down into those two buckets. You have co-founders that may have put their life's work into a body of research, a faculty member who hasn't just been working with you on the research as a graduate student that led to the topic that you'll be commercializing in the startup, but with many, dozens of other researchers in the past, having raised approximately, $10-20 million of grant dollars to fund that research. And that is a significant, contribution to the future company. It's past performance. And the other side, of course, is, who's going to be sticking with the company going forward? Who's going to be putting their life's work ahead of them? The most common thing I hear from both researchers, faculty, graduate students, postdocs, is they think the technology is solved. And it's just, snapping your fingers and selling the product that you can make from that technology. But two things I'd like to say is, one, I rarely see technology at a universities just convert into product easily, even if the product is obvious, which it never is. The technology is never as developed as people think. And also the product is never exactly what you think it is out of university. And so there's a lot of additional work that has to be done for the company going forward, in addition to all the sales that needs to be kind of figured out and strategized around as you kind of actually hopefully grow revenue. And so this balance of past performance and future performance is important. And I should have mentioned, equity is the engine by which you as a startup are rewarding yourselves and employees to be a part of the company, because you should not be paying yourselves a high salary. And so you need equity as that tool to bring in the best talent and reward your founders. And so we like to kind of think of things in the initial founder split pretty simply in a couple basic buckets. There's a lead employee or founder. Maybe that person is the CEO. Not always. We don't always encourage there to be a CEO in the earliest days of a company. And then there's co-founders and very early employees. And there's an option pool. I'll start at the option pool. So the option pool is what you should have on day one to hire a few of your newest employees. These are your, first founding engineer or first VP of manufacturing or first VP of sales. So your options are really important to incentivize those people. We'll go into that a little bit later, but because you don't want to pay these people a high salary, probably because you haven't raised much capital, if any at all, you need to give them equity in the company. And options are the tool by which you do that. And you want to structure those options in a way that, I always say, go to a lawyer, but in a way that you don't, that they're vesting. And so I can go deeper into vesting if people have questions on it, but it's basically a concept by which founders and employees do not necessarily get their entire equity allotment on day one. They have to perform, make sure they don't get fired within a year, 2 years, 3 years, 4 years, and it kind of vests in relation to that time period. Now, when you break up the remainder of the pie, this concept of a lead CEO or lead founder having significantly more than the other co-founders is complex to make sense of. Because while you think someone or your co-founders are all going to be working equally, it's generally never the case. And it's generally never the case that there isn't one person who seems to just grab that leadership role stronger than others, or that doesn't resonate better with founders. Oftentimes, like technical founders, science founders out of universities are seen equally, and I do view many of them as equal contributors on the technology front, but there's so many other things that the founding lead or CEO is doing. And so we usually see that person getting a disproportionate amount of the equity, especially if that person is a successful entrepreneur. So if you can find that lead CEO early on, they will typically deserve a significant portion of the company. And the other groups of co-founders, key employees, founding scientists, VP level, people should be in that sort of crunched in that 40% bucket. So that's kind of just a very holistic like view of how we see things. It gets, I go deeper in this presentation, but please interrupt me if you have questions about this. So I wanted to quickly kind of give some high-level concepts that you should be thinking about, because equity is what governs your ownership. And when you raise capital from venture investors, you get diluted by that. They're buying ownership of your company. And so that 100% pie that you saw on the previous slide needs to inject a new piece of that pie that belongs to your venture capital investors. And I just wanted to go over some basic terms that may pop up in this conversation and whatever you plan on doing in the future. So when a venture investor wants to invest in your company, they go through a diligence process, and if everything goes well, at the end of that, they give you a term sheet through which some of these terms are clarified and quantified. So the pre-money valuation is what your company is worth today. So I might say, I'm interested in investing in your company, and I believe your valuation is a pre-money valuation of $10 million. And I want to invest $5 million into your company. So you're doing a $5 million raise at a pre-money valuation of 10. And your post-money is basically what is your company worth after after those dollars go in. And it's, in this case, $5 million invested plus $10 million of previous value, pre-value, means your new valuation, post-money valuation, is 15 million. In the public markets, this is like a market cap is the post-money valuation, and your enterprise value is kind of like your pre-money valuation. And so that sets how much your company is worth at the end of the money coming in, but also how much I'm buying. And I'll go into that in a slide. Fully diluted is like people say, what's your fully diluted share ownership? This is all your shares that are outstanding. This is both your common shares, which you as a founder are getting, preferred shares, which are what investors are buying, and then any other convertible shares that may exist out there that could be converted into shares in the future. Your preferred stock is something I want everyone to make sure they store away and read about in the future. We're not going to go into it deeply here, but preferred stock is what we as investors get. As I mentioned, we're usually paying more than a previous investor if things are going well. And these are the things that give us preferred rights into your company beyond what a normal common shareholder may have, beyond what some of your co-founders may have. This generally means that we can take board seats potentially, or we can get our money back before you do. These are all the things that really are important about preferred shares, and we can get information. Common stock is what most founders will get. It is what founders get. It's also what your employees will get when they actually convert their options into shares. So common stock sits at a different class. Preferred stock is a higher class of shares. In the public markets, everything's common stock. So, when you think about how much you will be raising as a company, what you should be thinking about as a university spin out in general is that you're gonna have to raise a lot of money. This is a very challenging market to build companies in. Deep tech is called deep tech for a reason, hard tech for a reason. And it generally means a lot of times what you're building has big CapEx expectations or a ton of software development needs. So you need to hire expensive software developers. And so those operational expenses get to grow, as well as your CapEx. But also there's a time component. So your capital raise, you want to think of how much capital do I need to get through a period of time that will create a value inflection for my company. And so your capital raise should be defined by some amorphous equation of those three items. And the valuation that I as an investor may give you is an even less quantitative function of the risk that your company is at in this current stage, some revenue that you may have, some product vision you think you'll be going after, the experience of your CEO, and the market you're in. If you're in a very massive market, that obviously is a more intriguing thing than if you were, selling necklaces to giraffes. It's a small market. And so we want to think of these things. We also think about the risk. Not every company is great because they've identified a big market. That also has to be an accessible market. Otherwise, your risk is higher. So between those two things, the capital raised and the valuation, your dilution is decided. right? So if I give you a valuation and I offer you an investment amount, that governs your dilution. And that dilution percentage is the piece of pie that needs to be inserted into that pie chart I showed you before. And how much I buy is that amount. I'm buying, in that case, $5 million divided by a $15 million post money. I'm buying 33% of your company. And generally that should equate to the shares that I just bought divided by the total shares. So think of those kind of purchasing amounts when you're thinking about your ownership, because as soon as you build your founder's equity cap table and then you go raise dollars, there's going to be a couple new pieces of pie that get injected into the ownership cap table every time you raise money. So I wanted to walk you through an example of that. So instead of a pie chart, right, this is a bar chart. When we did an analysis, this was probably about 5 years ago, maybe even more. We kind of surveyed across the range of successful startups we've seen out of universities, and the average startup out of a university raised $41 million across 4 rounds of investment and exited for around $240 million. I'd say nowadays all those numbers feel small. There's been probably a similar amount, maybe more success. They've raised hundreds of millions of dollars, and some of them have exited for billions of dollars. But this is meant to be an average. But so the way to think about this is over 4 rounds of investment, you're raising $41 million. You're not raising $41 million in a single round, because if you did, the denominator would likely be really low. Like what you want to do is raise a little bit. In this case, in your seed round, let's say, I think you might be able to see my mouse, raise $1 million, maybe on a $4 million pre, so that your investors are only buying 20% of your company. And what you want to do is have that money last you long enough so that your $1 million turns into maybe $5 million of value. So in this case, your post-money evaluation was 5. You took that $1 million of capital and you got a $10 million pre-money valuation in your next round. You did great. You just turned 1 into 5. And the next investor that comes in is investing 5 on a $10 million pre, and they buy a little bit more of your company. And each time this happens, your ownership, let's say as the lead founder, decreases and decreases and decreases. And I always say the most important thing you can do is focus on creating the largest value inflection with the dollars you have. And obviously it's important to go for the highest valuation, but what you want to do is take capital from the people and the investors that are giving you the most fair valuation, but also can help you increase your future valuation by the greatest amount. So by the end of this example, when you exit, this founder who started with 30% is at 12% ownership. So your ownership goes down over time, is the message. What's too much? What's not enough is like an endless negotiation. But the clear thing to think about is you will get diluted. It's just what happens. If you don't get diluted, that means you've never taken on capital from another investor, and that may be a good thing for your company. It may not be a good thing. So, I wanted to break down that 30 or 40% split that we had in the previous slide a little bit. And because that's really what this talk is about. You're starting a company with some of your friends, some of your co-founders, maybe some people you don't even get along that well with, but they've been a part of the past success or past history that led to the technology. Like, what's the right way to do it? And these types of discussions are always going to be important to have openly and transparently, but they are better with data. And so what we did is we surveyed across our 100 or so university spin-out portfolio companies. These are the companies that we have data on. We have their cap tables. I can tell you what every single founder owned in that company at day 0. And we kind of tried to figure out what were the averages. And obviously this is a set of averages that is across our biased set of data. These are the companies that we've invested in. We've also invested with many, many, many other large venture capital firms. So it's a sample of those too. So it's not to say there can't be other configurations. It's just this is the sample size of our biased data set. but it is what I would call an investable set of companies. So just to get you oriented to this, and I provide kind of like a summary slide after it. I just wanted you to all see there's lots of data here, and it's also a little bit confusing because not every company in our portfolio started with the same number of founders, but we kind of tried to bucket things into groups of founding CEOs when there was a couple full-time founding inventors. And then we also labeled when there was a researcher or faculty member or graduate student who wasn't going to be full-time. They were going to be kind of maybe doing 20% a week, maybe nothing. And what did they receive in equity? As well as other early employees that were hired. And then also, since we work with universities, what were the averages in the university equity positions? And so these numbers are meant to be just something for you to look at and say, oh, wow, there's a lot of data here. But just as a reminder, there's no set rules. There's no exact equation you can use. You have to do what you think is fair, both to represent and reward the past, but also incentivize the future. So a couple takeaways. So without a doubt, founders who are committed to full-time roles are given more ownership than those who remain in academia. It's just something we've seen over and over again. It's the right thing to do because while it feels like things will be easy after the university, they're in many ways so much harder than what you just went through as a graduate student or what you just went through as a professor earning tenure. It's just different. It's difficult across so many new vectors because there are fewer fewer examples of success, I'd say, in the startup world. You just don't know what you're getting into. And many of the startups we see out of universities are cutting brand new paths in the market. And so it's a difficult world to go after. So that's just one takeaway. The other is that 10 of the 63 founding CEOs in our database were previously a professor or a graduate student. When they do, because typically when the professor or the graduate student are involved, they have this past performance bucket, as well as they're going to be working full-time as a CEO. They do receive a lot of equity. They're generally in this 40% slot. But of those 10 PI professors and graduate students turned CEOs, 9 were associated with a tech spin-out. And by tech in our world, we mean kind of like materials, semiconductors, robotics, cybersecurity, software. So if you are in the life science side, maybe therapeutics or med devices or diagnostics, generally those CEOs, those professors and grad students are not typically the CEOs, although there's a lot of kind of effort in Boston to do founder-led bio, which I'm happy to talk about with anyone in the future. It's just, in general, we haven't seen them step up as CEOs very often. And then, the equity that we've seen for founders varies very much by the sector they're in. Founders in tech startups have more equity than founders in life science startups. And it's generally because in the life science industry where there are fewer employees in therapeutics companies, because a lot of the work is contracted out, you just end up kind of increasing the ownership of the founders over time to counteract dilution. And then, if anyone in the audience is working with, some of these kind of celebrity professors, people that are Nobel laureates or at the top of their field, one thing that we have seen is that, and we've invested in a number of these, they have, on the life science side, 25% of our life science spinouts have involved a well-known professor. They are receiving more equity than you would normally expect, even when they're not working full-time at the company. And so that's just something to think about. There's actual value, there is real value in that, that we'll go into later. But it's definitely seen as a value add when you have a brand name professor who's raised from venture capital investors before. It significantly helps your company. And that, even though it might not be putting in labor 100% of their week, they're putting in that value in the future because they'll be able to help you raise capital, hire employees, and get industry attention. I'm going to pause and look at a couple of questions. So one of the questions is around salary, and it's kind of all across the map is the best way to describe it. there's a bunch of databases that are out there for kind of startup salaries that we don't have access to. I don't have a fresh one, so I just don't even want to offer to share it. But it's impossible to answer that question because it changes whether you're in a life science company or a software company or a hard tech company. And really what you need to do is emphasize the importance of option sharing or options and equity. So in general, like, let's just say I don't even know if I could estimate. You don't want to pay someone more than go get at Google and Facebook, obviously. It feels like there's anywhere, I've seen salaries for fresh PhDs, early engineers in companies between 120 and 200K, all the way up through when you want to hire your VP of business development at a classic tech company between 200 and 350. It's just such a broad range. It's very hard to describe because when it's low, it's usually complemented by really high equity. And what you want, I think the message actually to take away is that I should say to you all is, as you're building your company, you want to hire the people that want equity, not salary. And so that's what you should always look for. If someone, let's say you give someone an offer and they say, oh, thanks for the equity offer. Maybe we can go lower on the equity and increase my salary by 50K. That's a flag that you should be thinking about. So this is kind of a table view of everything that we kind of took away from our data and the guidelines that we think about when suggesting percentages to founders. This is pre-options. So in this kind of top half of the table, this is before you create the 20% option pool. And so when you have a founding CEO, founding CEO, founding inventor CEO, that kind of lead person, that person is probably going to be in this 30% range, plus or minus 20%. And obviously this large plus or minus is because it's really hard to tell what it should be when you have one other co-founder versus 3 other co-founders. But the real emphasis is, as you start to think of the other co-founders, you need to realize that you're splitting up the pie a little bit more. They're not going to be equivalent to what the founding leader or founding CEO is going to get. And if you're a part-time faculty founder, part-time technical founder doesn't just mean faculty, and you're not working full-time, that really generally means you're not going to have as much of an equity chunk as you may have thought. And we've historically seen around 5 to 10% for people in that category. And these range from a scientific co-founder to board advisor, but they're historically kind of in this 1 day a week or less bucket. And that's our recommendation for what we think for people that are in that role. As you think about other founding executives in the company, VPs of X, those, if you do get them at the early days and they are worth it, it's and they're valuable and they have experience. Remember, they're not doing much technical contribution. They haven't contributed to the past, but they do have what they've done in the past and what that could do for your company in the future. And so that is can be a significant chunk of equity for them, and that might be around 10%. And then on the university side, we have seen a range. A lot of universities have put a tremendous amount of resources into a IP package or the sort of proof of concept funds that may go to a company. And those types of efforts sometimes do look for more equity for the company because they don't necessarily want you to pay them back in cash. Universities have put seed capital into your startup packages, into the proof of concept funds, into paying for the patent disclosures. And so this is one of their ways of being compensated for the risk they took on you all well before anyone else in the investor world took a risk on you all. And so that's why universities usually ask for an equity piece of the startups that they're licensing IP to. And then after you raise your first capital, so post, you've created options and investors are maybe now sitting on a 20% piece of the pie, you may actually be looking to bring in a professional CEO, because there wasn't a CEO, and there was a CEO before that, but maybe it wasn't someone that was ever planning on doing it for the long term. And we always encourage you not to just bring in the CEO from the outside for the sake of bringing a CEO in, but because they're great. So, but when you do find that great person, after you've raised your capital, they should really be thinking about, and hopefully you're thinking about giving them around 5 to 10% of your company, which is a lot, because you may have just been diluted by 33%. So that could be equivalent to someone having come in at 15 or 20% at founding. But this is after dilution has happened, and so it's worth giving them a big chunk of your company, because they're going to be the guiding force for the company going forward. All the way down to engineers and board advisors. This is kind of meant to be a range. These slides will be available after this talk, so you all can look at it. But advisors are an interesting one, because these are the types of people that maybe come from the industry you're in, and they're not investors in the company, but you may want them on the board because they just add so much value, usually on the strategic side and then on the customer introduction side. And so really from your board, you should be making a big ask of having them help you, and you want them to have benefit in that upside, so they try harder. And so that's one reason you give some of your board members equity options as well. I think there's a question coming in. So one of the questions was, is the university component non-dilutable with investment? All equity is dilutable, and so it is dilutable. Some licenses have terms that are called anti-dilution terms, that will say something along the lines of the university gets 3% equity with anti-dilution protection through the first $5 million of venture capital dollars raised. And so that sets this anti-dilution equation up, which basically means after your first $5 million at any valuation, they will still own, I think I said 3%. And so that's how sometimes the universities do it. We're okay with it. We also just say, why not just do a rough estimate of the math and say, okay, if you want anti-dilution through 5%, and it's a 3D printing company, most 3D printing companies raise a $5 million round at a $15 million pre, and so do the math from there. So instead of 3%, maybe you just ask for like 5% going at the outbreak. So it protects against some of that uncertainty, and our universities that we work with have very strong views for anti-dilution, and in the end, it's just math to me, so I don't mind it very much. So as you are a researcher that's helped be a part of the founding bed of technology for the company, and you don't necessarily plan on working there full time, or you have worked there full time for a couple of years, but then you go back to the university because it's hard to leave the university permanently. What can you do for the company going forward? And there's a lot of value we've seen in some of the professors we've worked with in the startups we've invested in. So in tech, we do love to see researchers, professors leave the university and go work with the company for 1 or 2 years full time. It's actually something most universities are figuring out a way to make happen, because entrepreneurship is becoming such an important part of recruiting and growth as a researcher and industry connections. But it's rare that they leave the university permanently, so they'll often go back to the university. In life science, it's a little bit different. They typically stay at the university, but they'll be really active in the scientific advisory board. But in either category, it's really important for those people to just stay up to date on what's happening with their startup, so that they can help feed other technology ideas into the company, help create a sense of cutting edge for not just the round that they were a part of raising, but the future rounds that they will be raising, that the company will be raising from venture investors. But the reality is, over time, as the startups actually move to creating product, the role of a researcher that's not 100% in the company just diminishes over time, and that's okay. But they can be a pipeline for great talent from the lab. They can connect with other industry partners who are interested and for some reason are more likely to funnel to, let's say, Northeastern University than search the startup landscape. And it can just help with the various other PR opportunities that professors have that startups don't. to get the name out there. So it's always been really, fun for me because the researchers that we invest in, the professors we invest in, end up still being a pipeline of technology that come into our startups, and also a pipeline for other startups in the future too. And so that's really helpful if you're a professor who has been a part of startups before. The other researchers in your lab are just that much more likely to build a company as well. And so let's say you kind of go out, you get through this talk, and you don't listen to anything I'm suggesting, which is totally fine, or you realize, oh man, we kind of messed things up. What do you do about it? And what are the consequences? And I think there's some real consequences here. So, if you have a teammate, co-founder that isn't working full-time for the company and owns as much as you do, like it's really hard to claw that equity back. In general, you can't. I'm not a lawyer, so it's, anything can be done, I'm assuming, with lawyers. It's just, you have to pay for it. But the challenge is, if you're working full-time at this company and your co-founder is not, and they have equal ownership to you, it's just going to frustrate you. And there's one company I've invested in that had a poor equity allocation that we got over in our diligence and said, okay, this is just going to have to be the way it is. But that founder is still frustrated to that day. It's like saying Voldemort to him if you say that co-founder's name, because he just doesn't want to be reminded that 8 years after it happened, this person owns as much equity as he does. And the challenge is, as investors in the company, or as potential investors in the company, we can't just preferentially give or decrease that absentee employee's equity ownership. We can't specifically dilute one person. We could increase ownership for the person that's still working at the company, but you can't just create shares without diluting everybody. And so that's the challenge. The other is, if someone's sitting on the cap table, let's say with 10% of your company, and you're in your Series B round, and you need to, create new options to hire employees, you would much rather take that ownership from the person who's not contributing to the company. And so those are just some of the challenges that exist. And as I mentioned, investors really don't want to go through a recap. Like, we don't want to restructure a cap table. The only way we can really do it effectively, if you have, let's say, multiple people on the cap table that don't have the right equity, is we bring everyone down to zero and build everyone back up. And that's a really painful thing to do. And I'd rather just pass on a deal than clean up a cap table. So it has to be a really exciting opportunity. And don't forget, like, we're judging you on everything. And so if you've kind of made this, let's say, what turned out to be a bad decision in giving someone equity that didn't deserve it, and you didn't structure it in the right way, like, we will think about it. Like, we're going to say, like, oh, why did they make this mistake? But the same thing goes for bad investors. Like, I hope are not bad investors, but it's not just about your co-founder's equity. It's also the equity that you give to other investors and the terms you accept from investors that want to invest in your company. If you accept money from a controversial investor or someone who makes demands of your company that are unrealistic, or has misaligned incentives with you. Maybe they thought this would be a 3-year flip and they don't realize that quantum computing is going to take 20 years to be commercial. That can be a real issue that happens for you as a CEO or a founder. And you might really have an exciting company, but your investor that you took in at the early days asked for too many controlled rights, or they own too much of your company because you were in a vulnerable position and you had to take angel dollars from someone who tried to price your company. And so sometimes you just really have to be on the lookout for investors that don't seem like they'll be great partners, and think of your earliest investors as something like a co-founder is really what I would suggest. But I always think it can be best done by, whenever you're taking capital from anyone, is just ask to speak with someone that someone that's taken capital from them before. So due diligence on your investors, just like we do diligence on you as a founder when we're investing in your company. We'll try and talk to people that have worked with you, you should try and talk to people that have worked with the investors that want to give you capital, and it'll give you a sense for whether they will be parasitic investors. I've got some questions coming in. Let's see if I can get them answered. So, one of the questions is dilution good for raising money, but bad for the chunk of equity that founders hold? It's easy for me to say from my seat of, you need to take dilution, you need to raise capital, you need to be diluted to be a startup. There are plenty of successful companies in the world that haven't had to raise a single dollar of venture capital, and there have been some very big companies. There have also been some really interesting mid-sized small businesses that haven't needed to raise venture dollars. But I'm not certain who's on the call or the background of the general audience here, but from what I've seen in the startup landscape of university spinouts building on research established at a university, you will need to raise venture dollars. It's very high risk. There's a lot of CapEx. There's a lot of time before you'll start to sell, and you need to get employees to help build. And so that's classic venture. And the benefit is you need those dollars to create a big pie. You need to try to become a multi-$100 million business. And to do that, you might need to raise capital if that's your goal, but I don't think it necessarily has to be everyone's goal. Another question is it acceptable or recommended for co-founders to be co-CEOs and share 50-50 of the founding team stock, considering they've dedicated a similar amount of work towards the startup? I mean, in general, I'd say no. Like, it should be that there is, like, I expect in most situations, one of those two people is going to be a stronger contributor to the fundraising and the team building. But if it's not the case, if you two are really kind of, your background and contributions in the past were the same and your plans for the future are the same, then maybe it is 50-50. In that situation, and in situations where I've seen co-CEOs, usually there's a CEO that comes in later. And so that person would be getting potentially more than you or a similar amount to you, even though they haven't had a past contribution. One of the questions was, can one of the co-founders buy into the founder's equity who is not full-time or contributing to the company? I don't quite follow that question. So if you want to clarify it in more detail in the chat, please do. But in general, you can't buy into founder's equity. Co-founders, employees, can be investors in your company. They can put real cash into your company, just like we as investors do, and they can buy more ownership of the company that way. So that's something to think about. And we love it when people find ways to invest their own money in the company. And so I just, we talked a lot about founders' equity. I thought it would be also make sure everyone understands what the option pool is. And as a reminder, the option pool is this, let's say, pool of capital, pool of equity that you have that's structured as options, not common shares. But when you hire somebody, when you build a team, you're not paying them a big salary. So you need to incentivize them with a % ownership of your company. So when you hire them, you need to give them options. When those people leave, they may exercise their options, and so they'll own a portion of your company. And then every time you raise money, let's say that 10% unallocated option pool that you had will also get diluted just like your own equity. So 10% optional may go down to 7%. And so every so often you need to refresh your option pool to build it back up. So sometimes you may start with, let's say, a 20% option pool when you first begin your company, but then in the next year and a half, you've hired 20 people and you gave them each a % of your company. You now have 0 options to give out to future hires. And so you have to refresh your option pool, which is really just you create shares, and you usually do that alongside a fundraising event. And this is just as a reminder, like you're definitely going to need to build your team. These are companies that take a lot of work, as I mentioned. building your team is going to be dilution on you as a founder. But if you don't build that team, as George Costanza says, you'll have nothing. And so it's really true. I haven't seen a single multi-$100 million startup with only the founders, except for a few cases in the software space, but it's really rare. And if you don't do this, if you don't build your team and you don't think about accepting dilution, you're just going to be left with a big piece of a small pie instead of a small piece of a big pie. And so what you really want is to preserve this big pie, optionality to build a big pie, because that is kind of the path to a hopefully larger financial gain for yourselves in the end, which isn't the only value of building university spin-out. There's a ton of rewarding lessons and experience that our scientific founders have gained in the process of failure and success. And so I think that's it for, oh no, let's see. I have a couple of things that I wanted to quickly mention. I was going to go into equity and dilution, but let me take a pause and see what questions we have. One of them is it common to restructure the cap table during the first round investment due to a change of part-time or full-time, or is it a red flag to investors? I think it's better. I mean, obviously, if you haven't taken a single dollar of venture capital, it is the best time to do it before you do raise capital, because we have lots of preferred rights that may block your ability to do it later. And it's good to do it beforehand. The only challenge, and so I think you should please consult a lawyer. The only challenge that I've heard in one experience was it just kind of opens you up for lawsuits. Like could be, unless you all are truly on the same page. And so something to think about is in most situations where you're taking equity away from someone, they're not going to be happy about it. And so it could just be an opportunity for lawsuits down the road that I know I think about when I do see those situations. The next question is, can you give a clarification about the difference between the dilution and the change of percent in equity that founders hold, which I remember is not, okay, sure. So I think I might be able to hit that pretty quickly on this side. So there's not much of a difference. Equity is what you own in your company, or equity is what someone owns in your company. And dilution is, in the case of an investment, dilution is basically how much someone else is buying of your, is equal to how much someone else is buying of your company, and you get diluted by that amount. So it's like water being added into a salt brine. And so you need to think of it as like ultimately you are going to, if you started with 40%, you're being diluted a certain amount because you had to create shares out of nowhere to give this new investor. And so that's what dilution means. And the equation of dilution is not always, but hand wavy. It's the dollars you raise divided by the post money of the round. So that's how much you're being diluted. In this case, when they raised a $5 million seed round on a $15 million post, they've been diluted 33%. And so the founding CEO who owned 40% will own, after that 33% dilution, 27%. The simple equation is 40 times the quantity 1 minus 33%. So this is an example I wanted to run through of like a situation where you raise some dollars and then you have an exit. And so this is Startup Z is going to be acquired for $250 million. They raise a Series A where they have a $15 million raise on a $60 million pre. And there's a couple different terms. There's a non-participating preferred 1x. There's a participating preferred 1x in the Series A. And they get acquired for $250 million. And they've only raised $20 million. This is a good outcome. This is a great outcome. Typically in this situation, not typically, in this situation, all shareholders, common, options, and seed and Series A investors are going to convert to their percentage ownership, and they're going to get the percent ownership times the exit value. So 20% ownership for the founder is going to convert to $50 million. The investors who bought 50% of this company over 2 rounds are going to get half of the $250 million exit, it's a great return for everybody. Seed investors made a great multiple. Series A investors made a slightly less great multiple, but everyone's happy. Now, when you do have an acquisition offer, though, by the way, don't forget, even when you read them in the news, but obviously if you're building your own company, sometimes there's milestone payouts and bio bucks, as they call it, where it might actually only be a $100 million acquisition and $150 million in payout, based on how you do once you're in the merged entity. But not all situations are this rosy. In the next scenario, I wanted to show you what happens in a downside of, you've raised $20 million and you, for whatever reason, have to accept a $25 million acquisition offer. Seems like there should still be plenty of money to go around. But there's not, because as I mentioned earlier, investors with their preferred shares take their money out first. So we have the option of taking our money out first, generally speaking, 1x our money out first, not always. Or we could convert to common based on our ownership, like we did in this upside scenario. If I did that in this other scenario, where it's a $25 million acquisition, I'd be getting 50% of $25 million, which is only $12.5 million. That doesn't recover the $20 million that was invested in the company. What does happen in this case is investors leverage the fact that they have liquidation rights, which means they can liquidate their equity ownership first. In the case of the Series A investors, they did a participating preferred 1x, which means they both get the $15 million back and they get a certain percentage of what's left. The seed investors did a non-participating preferred, which is a very vanilla, normal way of investing, but it still means they get their $5 million back first. So in this scenario, the investors are taking $21.7 million of the 25 and leaving not very much for the other option pool holders and co-founders and CEO. So it's kind of a really, eye-opening thing that you have to think about when you're looking at an exit and evaluating your options. I really suggest that everyone reads this book called Venture Deals by Brad Feld. It goes through a lot of this type of basic math and all the different constructs of terms that investors use in the way they're doing deals. One question popped in is, can you explain the difference between preferred stock, which investors get, and common stocks, particularly in the scenario of an exit? I mean, the classic one is what I just described, is we can choose as investors to use our liquidation preference as a preferred share, or we can convert to common, which will be, in an upside scenario, I would rather convert to common and get 50% of a big amount than stay preferred and only get 1x of my amount, if that makes sense. If I have participating preferred, that's the best. It's called double dipping. I get my money out first, and then I can get my percentage of whatever's left.
Thank you. I'm actually a little bit confused because it seems like when the startup is not doing well, then maybe preferred is a better route. But if the startup is doing really well, then common stock for investor is a better route. So what, like in both scenarios, what is it that the investor is going to exercise?
Yeah,
I mean, I understand that
sure.
If it's not doing well, you will go for the preferred route. But what happens when?
In this scenario, most everyone will switch to common, except for in this scenario, everyone's going to switch to common. It's possible the Series A investors they'll just do their participating preferred and get their 1x plus. They'll also double dip and get the converted common ownership percentage of the rest. So everyone converts to common in the upside scenario, almost always.
Okay, thanks.
Because the other rights that you have as preferred investors don't matter after you're acquired. So there's lots of differences in common and preferred, but when you're acquired, it's just about the payout.
Okay, thank you.
Sure. So, just, I think this is the last slide, when it comes to equity ownership, dilution is an important piece of the puzzle. It's going to be a part of almost all the startups you're thinking about building. And it's just make sure you pay attention to the terms that control how you get diluted and what will control a payout. So make sure you understand dilution math. It's not rocket science. Make sure you understand liquidation preferences and the difference between participating and non-participating preferred. In the past couple of years of market exuberance, all the terms were very vanilla. Investors did not have the power, and startups had a lot of negotiating power. And so most investors were doing non-participating preferred 1Xs. You're going to start to see more terms that are investor friendly. And so just be aware of the importance of those, because it's not just about accepting it at the time of that investment. Future investors are likely going to want the same terms as someone that came before them. And so as you're doing your diligence, as you're thinking about raising capital, do the math. We're invest from the investment side, we are, and you should too, as should all the tech transfer offices that you're working with, and they should be able to help you work through this. So I always like to say, feel free to reach out to me whenever, but you have a great tech transfer office that's worked with dozens of startups over the past several years to figure out much of this and can hopefully help you all sort through it. So with that, happy to answer any final questions that anyone has. It's been great to get this conversation going in real time. So thanks for all the input over the chat.
Thanks so much, Manny. If there are any final questions here, we have about 2 minutes to take any final questions. Thank you. I'm seeing some virtual applause. I agree. So just a couple minutes for final questions here. Please follow us on LinkedIn if you don't already for future events such as this one that you joined today. It was great to have everybody on the call. The recording will be available as well as the slides, I believe, as Manny confirmed earlier, after this presentation today. And we appreciate you joining.
Good. We got one question that came in.
All right.
Oh, of course, it has to be about safes. What role do safe equivalents play for co-founding professors or the university? And how are angels negotiated when CVs come in? To me, CVs mean corporate venture groups, VC. Okay. Yeah, sorry, I should have. And safes are just convertible notes. In the grand scheme of things, they were created as this brilliant idea by Y Combinator. The reality is they're just startup friendly versions of convertible notes that aren't debt. So they don't sit on top of the debt structure. But in terms of what I think about them, they're actually a great tool for the early days of your company when you are accepting capital from likely friends and family or angel groups, and potentially investors that have no idea how to price your company. So they could both price it incredibly high and change your expectations of what your next round should be, or they could price it incredibly low. And so we always recommend using convertible notes, which just convert into some discount on the next round. And they sometimes have what's called a cap. It's probably a lot of detail to get into here, but I view them completely fine from a university's perspective. It doesn't change too much about how I think they should be structuring their licenses. But I'm happy to chat offline if anyone has any questions about it. So thanks, Katie, for organizing the event. And thanks to Northeastern for being partners with OUP.
Thank you, Manny. Great to see you.
Great.
Thank you
Thanks,
all.
everyone.